you ever looked at the Forex chart and thought, wow, how do traders know that price is about to go up or down? Well, it's not magic. It's about identifying patterns. In this video, I'm going to walk you through popular bullish chart patterns that can help you predict when the price is about to go up. In Forex trading, timing is everything. You can pick the right pair, but if you enter the market at the wrong time, your trade can go south fast. That's where charts come in. They give us clues and visual signals to help us know when buyers are stepping in, momentum is building, and a bullish move is on the way. In this video, we will break down some of the most common bullish continuation and reversal patterns, from the classic bullish flag to the double bottom to the inverse head and shoulders. All of these will be explained in simple terms and of course with chart examples to help you understand it properly. And by the end of this video, you should be able to recognize bullish patterns on your chart, understand what they tell you about market psychology, and most importantly, know how to trade with bullish patterns. If this is what you are interested in, stick around till the end. Now, what are bullish chart patterns? Think of a chart pattern like a visual language that the market uses to communicate what traders are thinking or feeling. Price is not just moving randomly. Every line, every consolidation, every bounce tells a story. And bullish patterns are patterns that form to tell us that price is likely to move higher. It tells us that buyers are gaining strength. So when we talk about bullish chart patterns, we are talking about specific shapes of formation on the chart that tells us that price is about to move higher. So bullish chart patterns form when price is either reversing from a downtrend to an uptrend, or when an uptrend is continuing. So if price has been falling and you see a bullish chart pattern on the chart, that may be an indication that sellers are losing power and the bulls are about to take over. On the flip side, if price have been moving sideways or pulled back a little during an uptrend and you see a bullish chart pattern forming, that may be a signal that the uptrend is going to continue. The uptrend is not coming to an end just yet. Bullish chart patterns that form during a downtrend are called bullish reversal patterns. These are patterns that tells us that the downtrend is about to come to an end and the bulls are taking over. And bullish chart patterns that form during an uptrend but then there's a minor pullback or sideways movement of price are called bullish continuation patterns. These patterns are important because they help you spot high probability trade setups. They give you more confidence to enter a trade, better timing, and a clearer risk management, especially when combined with support and resistance and trend lines, as well as indicators and Fibonacci retracements too. Now that you know what bullish chart patterns are, let's get into the key bullish chart patterns that you need to know, starting with the bullish continuation patterns. Like I said earlier, bullish continuation patterns are patterns that form during an uptrend, and they suggest that price will continue to move in an uptrend after a pause or slight pushback. They signal that the market only took a brief breath before the next move. Now let's look at 3 key bullish continuation patterns. First, the bullish flag. Picture this. The price shoots up quickly. That's the flagpole. Then it starts to pull back in a slow downward sloping channel. That's the flag. It looks like the market is resting, but in reality, buyers are regrouping and are getting ready to push the price back up. The sharp move shows strong buying momentum, and the flag portion shows a temporary pause but not a reversal. It's like the bulls are saying, we are not done yet, we are just catching our breath. Let's see how to trade the bullish flag. First, wait for price to break the upper trend line of the flag. Then enter your trade on the breakout. Set your stop loss just below the flag. A common profit target is to measure the height of the flagpole and project it upwards from the breakout point. The next bullish continuation pattern on this list is the bullish pennant. The bullish pennant is similar to the flag, but instead of a channel, the pullback forms a small symmetric triangle where the highs and low converge. It usually happens after a long upward move but does not last for long. The market is consolidating. Volume is drying up a bit, but traders are watching closely. Once the breakout happens, it may be a sign that the bulls are back in control. Now here's how to trade the bullish pennant. Wait for the breakout above the triangle. Enter your trade just after the breakout. Set your stop loss below the trend line. For take profit target, it's almost the same as the flag. Measure the height of the move before the pennant and project it upward. Remember to always wait for confirmation after the breakout. The third bullish continuation pattern on this list is the ascending triangle. This one is easy to spot. It's a horizontal resistance line on top and a rising trend line below. Each time price pulls back, it forms higher lows, showing buyers are becoming more aggressive and willing to pay higher prices. What this tells us is that buyers are holding the line of resistance, but they are becoming weaker. As buyers keep stepping in sooner and sooner, eventually the pressure builds up and price breaks the resistance. Here's how to trade the ascending triangle. Enter on the breakout above the resistance. Place your stop loss just below the most recent higher low. For take profits, measure the height of the triangle and project it upwards. These three patterns are powerful because they let you ride the trend without chasing price. However, you should always remember to wait for confirmation, and you can always use tools like support and resistance, Fibonacci retracement, and indicators to confirm the signal you get from these bullish continuation patterns. Always confirm your signal to avoid trading on false breakouts that may end up making you lose money. Always confirm your signal. Now let's move on to bullish reversal patterns. Like I said earlier, bullish reversal patterns are patterns that form in a downtrend. So when the market has been moving in a downtrend and we see bullish reversal pattern, there may be signals that the downtrend is coming to an end and there's a change in direction to the upside. These patterns tell us that sellers may be losing steam and buyers are stepping in, so you should expect bullish movement. Now let's talk about three common bullish reversal patterns, starting with the double bottom. The double bottom is one of the well-known bullish reversal patterns and it looks like a W. The price drops, finds support, bounces back, drops again to the same support level, and then rallies upward. Now here's what is happening when you see a double bottom chart pattern. On the first drop, sellers are in control, but buyers step in and push price back up, but not enough to start a new trend. Price drops again to test the same support, but this time it does not break lower. That's your signal. Buyers are defending that level and the market may be ready for a reversal. Here's how to trade the double bottom chart pattern. Wait for price to break above the middle peak, the highest point between the two bottoms. That's your confirmation. Enter your buy trade after the breakout. Place a stop below the second bottom. Now for take profit, measure the distance between the bottoms and the middle peak, then project that distance upward. The next bullish reversal pattern on our list is the reverse head and shoulder pattern. This looks like a human body turned upside down. The first dip is the left shoulder, the second deeper dip is the head, and the third shallower dip is the right shoulder. It forms after a downtrend and signals that buyers are gradually regaining control. The market tries to fall 3 times, but each time sellers get weaker and buyers come in stronger. The key level to watch is the neckline. That is the resistance line that connects highs between the shoulders and the head. Now here's how to trade an inverse head and shoulder pattern. Draw the neckline. It's usually a horizontal or slightly sloped resistance line. Wait for price to break above the neckline before you enter a trade. Enter after the breakout. Then place your stop loss below the right shoulder. For take profit, project the height from the head to the neckline upwards to set your target. The third bullish reversal pattern on our list is the falling wedge. A falling wedge is a bullish reversal pattern that forms when price is making lower highs and lower lows, but the slope of the lows is starting to flatten. It looks like price is being squeezed downwards into a narrow cone shape. When you see a falling wedge pattern, here's what is going on. Even though price is falling, the selling momentum is slowing down. Buyers are quietly building up strength, and once the wedge breaks to the upside, it often leads to a sharp rally. Here's how to trade the falling wedge pattern. Wait for a clear breakout above the wedge's upper trend line. Enter a trade after the breakout candle closes. Place your stop loss below the recent swing low. For take profit, your target can be the widest part of the wedge projected upwards from the breakout point. Now, although these patterns are powerful, never jump in blindly. Always confirm the pattern you get from any chart pattern at all. Always confirm the pattern. You can confirm your pattern using the candlestick, the last candlestick that closes after the pattern is formed. You can also confirm your pattern using support and resistance, Fibonacci retracement, and indicators. But always confirm the pattern before you enter any trade. Now let's go ahead to see how to trade bullish chart patterns properly. Spotting a bullish pattern on the chart may be exciting, but the real thing is understanding how to trade with these patterns properly. So you are not just trading based on hope, you have an actual strategy. I know we've already talked about how to trade the individual bullish patterns that we've discussed in this video, but let's also see how to trade bullish patterns as a whole, and let's break it down into 5 steps. First, confirm the pattern, wait for the breakout, manage your entry, set your stop loss, and choose a realistic take profit target. Let's expand each of these points properly so you can understand them. Number 1, confirm the pattern. Before jumping into a trade, make sure you are seeing a valid pattern, not a rough sketch, not an incompletely formed pattern, or not just riding on hope. You are seeing an actual valid pattern. One question you want to ask yourself is the trend leading up to the pattern clear? For example, a bullish continuation pattern should form during an uptrend, but when there is a slight pushback. And a bullish reversal pattern should form during a downtrend. So if you are seeing a bullish reversal pattern, but it's not a down, like the overall market trend is not a downtrend, you want to question that pattern you are seeing. Ensure that the trend leading up to that pattern is in line with what is expected. Another question you want to ask yourself is, are key levels respected? Is the key support, resistance, and trend line clear and respected? So if support, resistance, and trend line are not properly respected and clear, then you may want to take steps back to look at like your strategy again. The next point is for you to wait for a breakout. Never enter a trade without 1, confirming the pattern, and 2, waiting for an actual breakout. One of the biggest mistakes that beginners make is entering too early without properly waiting to see like the next market move. So you don't wait for the chart pattern to be complete, you don't wait for a breakout, you don't wait for confirmation, you just want to enter the market because you have hope. You are assuming. Always wait for a clear breakout. For example, in a bullish pattern, a clear breakout will be when price breaks above the resistance. To help you manage your time, you can set alerts on your chart so that you are notified when there's a breakout, and that way you don't have to stare on the chart like throughout the day. Number 3 point is to manage your entry. Now there are 2 strategies you can employ for this. First is the aggressive entry. That is, you enter right at the breakout. And then the second is the conservative entry. You wait for a retest of the breakout level and enter on the bounce. If you are cautious and wish to avoid certain risks, then you can be conservative. But if you are somebody who is willing like to take the bull by the horn and take as much risks, then you can be aggressive. But of course, it's usually safer to be conservative. Now the 4th point is to set your stop loss. No matter how confident you are, every trade comes with risks. So it's important that you set your stop loss. So just in case the market moves in your favor, you don't lose all your trading capital. There is a general rule of thumb that you should not lose more than 1 to 2% of your account in a single trade. If you can keep to this, then you are able to stay in the game and continue to trade even after making few losses on trades. Now lastly, choose a realistic take profit. You can use the pattern structure to estimate logical targets. I think we explained this when we're talking about each of the bullish patterns. However, if you do not want to measure the height of the pattern and projecting it upwards to identify take profit levels when trading with bullish patterns, you can also set your take profit using resistance. Now, during the course of this video, we have briefly identified some of the mistakes that traders make, especially beginners, when trading bullish chart patterns. However, let's go a little deeper into mistakes beginners make when trading bullish patterns. The first of this mistake is jumping in before the pattern is complete. So you are seeing the pattern form and you are so excited and you just want to enter a trade so you don't miss out. That's not wise. Always wait for confirmation. Always wait for the pattern to form completely and confirm the pattern before entering a trade. Sometimes the pattern may not completely form, so the pattern starts forming but does not complete, and that way you cannot get an accurate signal from an incomplete pattern. Also, what if the pattern forms completely but the signal that it gives is wrong? So what if the pattern forms completely but instead of a breakout, price continues to go down and it gives a false signal? So you always want to be patient and wait for confirmation. Wait for the pattern to form, confirm it before you enter a trade. Another mistake that beginners make is ignoring the big picture. So you are zooming in on a 15-minute chart and the pattern looks great, but you fail to check the 4-hour chart and the daily chart. If you do this, you might be trading against the overall trend or buying into a strong resistance zone without realizing it. Zoom out. Always check higher time frames before entering the market. Make sure your bullish pattern aligns with the overall trend and structure and does not clash with major resistance zones. Another mistake that beginners often make is forgetting risk management. So you see the pattern, it forms clearly, and you are so sure that this pattern is going to work. You are going to enter a trade. You are so sure to the point that you failed to set your stop loss. What if the signal fails? What if the market goes against your favor? There is always a risk. So setting your stop loss is not lack of faith that your pattern is going to work. Setting your stop loss is just a way of preventing yourself from losing the entire money in your account in case the market goes against you. So always use stop loss. If possible, work with brokers that offer guaranteed stop loss, so you are sure that your stop loss will be triggered just at the right time. Another mistake that beginners often make is setting unrealistic take profits. So you are seeing the pattern, you've confirmed it, and then all of a sudden you are imagining how you are going to 100x your capital. It doesn't work that way. The market does not care about your dreams. If your take profit is too far away, when price hits, after price reach resistance, it might start reversing and your take profits may never be triggered. So after making a lot of profit, you begin to lose because you set an unrealistic take profit. Set your take profits based on the patterns measured, like we have explained earlier in this video, or you use the next logical resistance when trading bullish patterns. Stay realistic. I know you have big dreams, but you are not going to get those millions that you need to live the kind of lifestyle you want to live from just one trade. It's progressive. And lastly, on mistakes that beginners make when trading bullish patterns is over trading patterns. Now you've learned about bullish patterns. Everywhere you see them on the charts, you just want to enter a trade. You want to enter a trade so that you don't miss out. No, you don't have to trade all the bullish patterns that you see on the charts. Some patterns form clearer than others. So not all setups are worth trading. And if you are just jumping on every pattern that you see that forms on the chart, you may end up trading based on your emotions and not actual logic. This means that you should be selective. Only trade high quality patterns with good structure and a clear breakout. Remember that it is better to take fewer trades with high accuracy than to take so many trades with low accuracy. The truth is that bullish patterns are powerful. However, they are not magic. They only work when you trade them with discipline and a solid plan. And also note that if you're a beginner in forex trading, the truth is that it may take you some time to properly learn how to identify good patterns on the chart and trade with them. So it's good that you practice, use demo accounts to practice your risk management before trading with real money. And just in case you don't know already, we have a free forex trading community where you can come to interact with other traders to know what they are thinking. This can also help you in your decision making. And this video is a part of our product called My Trading Land University, where we help beginners understand the basics of forex trading. To gain access to My Trading Land University, just visit mytradingland.com. It is absolutely free and we have both video and text-based resources. On My Trading Land University, you also have access to our community where you can interact with other forex traders. All of these free of charge. You don't have to pay a dime. Just visit mytradingland.com. I really hope that you found this video helpful. If you did, don't forget to leave a comment and of course give this video a thumbs up. Subscribe to this channel and turn on bell notification so you are always updated when we leave a new video.